which is a trend line liquidity. Like I said, to confirm a trend line, it has to have a minimum of like 3 touches. We have 1 touch, 2 touch, 3 touch. So there are people that traces based on trend line. So in a case like this, they are already long, they'll just buy. But we, based on the strategy we are using, we only use it as a conference. So upon confirming this trend line, and I know that the market is a downtrend, and I know something just happened here, then to me and to us, we know that the market will sell. For those that trade pattern, this is also a bullish channel. But I don't need to be mentioning pattern because I think you're not really familiar with it. We can call it a bullish channel and can also call it ascending triangle. So that's that about. So do you have any question on session I and Asia Wind?
No, bro. No.
Happens everywhere. Let me show you another example. I was looking at GBP AUD and GBP NZD because I realized there are some times, especially now, I don't know if you know, like there's a possible recession that is bound to happen. So there are some. I was looking that I need to be, looking at this pair. I'm not trading them. I'm just going to be movement and all because the majors are, the way they are moving now is just crazy. And everything is happening here also. If you check this place well, you see that we have 2 lows. One falls inside Asian range and one falls inside London session.
Yeah.
Can you see?
Yes, bro.
So the one that falls under London session is the London low.
Yeah.
What happened? This one even closed that week is very powerful. Can you see? Shoot up. Went very far. There are many theories that back Fibonacci. The man, the founder of Fibonacci is a mathematician. His name is, I think, Leonard Fibonacci or something. Let me check. I'm correct. His name is Leonardo Bonacci. He's an Italian mathematician. Came about the whole numbers and sequence. It's a long story. So the point of the story is you don't need all those stories. You don't need it. If you find out, it will convince you. So now let's get to what you need. Have you been using Fibonacci before?
But I don't use it, but I've used it like way back. Like those are some of the strategies I learned. Like when I was in the retail stuff, YouTube.
Okay. There are two things you need to know.
But I only
Go on.
like I only use it in cases where I normally don't see an order block on the swing high and the swing low. Like when I don't see an order to show that Fibonacci. Like I used to draw it when I don't see a clear order block.
Okay.
Yeah.
My network is slow. Damn. We have Fibonacci retracement, we have Fibonacci extension, if we decide to go deeper, trust me, it's irrelevant. Because in this market, you see, the market is funny in the sense that the reason we are trading is to make money. Do you understand? And I mentioned this yesterday. And the way you can make money is either you buy or you sell. And before you know how to buy or sell, you only need to focus on few things. Okay, I know how to make money. And it's either the market goes up or down, which means it's either I buy or sell. So it means for me to make money, I need to know the exact point to buy and the exact point to sell. I need to know what I need to know to buy and sell. So there's some people that they only know one thing in forex, just one, and they don't care anything else. So the moment we're beginning to go, we have Fibonacci extension, we have retracement, we have many. But I'll tell you the one I use, just one, and that's what you need to know. And I believe that's what most traders that I respect, like $1 million traders, that use. Let me toggle this on. Talking about Fibonacci, we want to be using Fibonacci to find retracements, retracement of price. And when we talk about retracement, you are only using Fibonacci because of two things. To find a 50% retracement of the current trading range and the 61.8 retracement of the current trading range. So the 61.8 retracement is also 0.618, and the 50% retracement is also 0.5 level. So let me draw it. This is Fibonacci. I've picked Fibonacci now. So I want to start, and let me reset it right before. So now this is Fibonacci. Can you see?
Yeah.
You come to settings. Like I said, we only need two numbers, which is this, the 0.5, which is the 50% adjustment, and the 0.618, which is also 61.8% level. So you toggle off this, you leave this 0 and 1 because they are the swing high and swing low of the Fibonacci. So you toggle off this, you toggle off this, you toggle off this, you toggle off this, this, then you toggle off this and this. Give me a minute, sorry. So sorry about that. So, like I said, when you pick the Fibonacci, you only want to focus on two numbers, which is the 0.5, that's 50% retracement of the trading zone, and 0.618, which is 61.8 retracement level of the trading zone. Then you toggle up everything, you leave the two numbers. This, if I toggle up this 0 now, you see that, That's the highest point that we need to be wary of. So we want to leave it toggled off. Same thing here. So these are the only numbers you're gonna leave. Then you okay. Now the 50%. Can you hear me clearly?
Yeah, I can see.
Now the 50% is a retracement level that you want to focus on when the market is. You only use Fibonacci when the market is trending. Don't forget. You only use Fibonacci when the market is trending. So you want to focus on a 50% retracement when the market comes down. Now, for example, we have an uptrend. Higher high, higher low, higher high, higher low, higher high. Firstly, this is a trend line liquidity. Am I right? The market will never come to extreme all the time. Like I said, when the market comes to an extreme, all you have to wait for is, probably all you wait for is a lower time frame entry pattern. Even though you don't have a valid order block, once the market takes out liquidity and takes out the extreme, you wait for a valid entry pattern and you buy. And sometimes can have a valid demand zone. That's an higher conference. But now, my point here is, let me delete this. Even though there is an extreme liquidity, there's a demand zone, there's a trend line zone, and the market is trending. The market will never retrace more than 50% all the time. This is what will happen. You mark your Fibonacci. If it is a buy trade, you mark your Fibonacci from the swing low. You mark your Fibonacci from the swing low. Take it up to the swing high. Can you see?
Yes,
so all you want to be focusing on is this. Is that the market taps back on the 50% and retraces in the original direction, which is this. That the market taps down, retraces in the original direction, or it taps down and click the 61.8. And there is one powerful thing about 61.8 zone. It's what we call the golden zone. Have you heard about the golden zone?
Oh, only today.
Yeah?
Only today. Just heard it from you.
Only today?
Yeah.
Okay. This is what we call the golden zone. You can remove this background. When you come back to the settings of the Fibonacci, you scroll down. This is the background there. You just toggle it up. So you won't get confused. Now toggle it up. So is either the market, when the market is really trending, you would want to wait for price to come down to the extreme all the time. So that's why people say react to what the market is showing you. You don't predict. You wait for the market to give you malpractice. That's why I like to call it. So the market will be telling you that this is what will come out, this is what will happen. So your own is just to, okay, I know this thing, execute. Oh, I know this thing, execute. Is that I win or lose, I move on to the next trade. Is that I win or lose, I move on to the next trade. Oh, I don't know this trade. Oh, okay, let me see. Don't bother to see anything. If you see one, just leave the chart. Simple as that. So now, talking about Fibonacci, when the market moves up and trend is down, so is either you wait to see what happens on the 50%, which is this. Can you see? And if you what happens, then you wait for the golden zone. So if upon the golden zone we have support and formally we have support and resistance and we have maybe the session high and low taken out. So now you have to reference to back to what I've been teaching you. In a case like this, you won't just enter upon price reaching the golden zone. After the golden zone, you want to be looking for probably a support or a resistance to support one. You want to be waiting for the high, the previous low taken out, or the Asian range taken out, or session high and low taken out. So like 2 or 3 or 4 things you want to make sure like 3 or 4 things is confirming to you that this market will buy at that zone. You understand? So the golden zone is not like the principal confluence. Then the last thing you want to do is just to wait for your lower time frame entry after you've confirmed everything and you buy. Simple as that. It's a matter of gathering enough confluence before executing any trade. Simple as that. That's all you need to know about Fibonacci. You want to be focusing on these two numbers. The 50%, which is the 0.5, and the 6.18, which is 0.8, and that's what we call golden zone. Now, you see the magic now. And you need to also have a knowledge of structure. That's why structure is the basis of everything in trading.
Yeah.
What is this? This swing guy is called what? What's it called?
The what? The high?
What did you say?
Pardon?
This swing eye, what is it called if you want to draw structure?
What is it called?
Yeah, I'm asking.
The high.
Very good. So now, I want to draw the lower low because we are coming down. My lower low, is it this or this?
Your low.
Is it this or this?
To me, I think there is no lower low there.
There is.
It would have been the red candle, but I don't see a breakout structure.
You know why there is? Because a spike is here. That's number one. Yeah, okay, I understand why you said there is no lower low, but this is what confirms it to me. The eye was broken.
Oh, yeah.
Can you see?
Yeah.
So let me and just draw it. So this is higher high, higher low,
yeah,
high, higher low, higher high, higher low.
Yeah.
Higher high, higher low, higher high, higher low. Remember what happened there?
Price did not break.
Okay. There was nothing here. There was nothing. So now I want to show you the magic of Fibonacci. I've got my Fibonacci tree. Now from the higher high to the higher low, what did you notice?
With the Fibonacci retrace to the in between the 50 and the 61.
Now from the next higher high, so from the next lower high to the next lower low. Okay, this is not valid because we have anything, nothing. So now the next higher high and the next lower low. Let me clear this so you don't get confused. What do you notice again?
Price reaches to the 61%.
So all these things are confluence. They are related, they are interrelated. Now, from the next lower high to the next lower low, what did you notice?
Yeah, again, price reaches 61.
Let me see. So you want to be gathering everything and you simplify it. So if you see that you can have up to 2, 3, 4 conferences, don't enter a trade. It doesn't matter if you wait for 1 year. Of course, you can't wait for 1 year because you're a day trader. The opportunity will always present itself. Now let me show you example on Euro USD. We shouldn't go to the 4-hour time frame. This is higher high, higher low, higher high, higher low. Created a new higher high, higher low. No, the higher low was here. We have higher high, and we have an higher low. Now, the only valid place we can use a Fibonacci here is this. Never forget, because this is higher high that created a new higher low. These ones are not higher low because it's not valid and we have no inducement sweep. Now, when we created a new higher lower low, what happened? Market traces back to the golden zone, the zone between the 50% and 61. What happened? Look at that sharp selling.
Yeah.
Can you see? Now we have many confluence here. We have downtrend, number 1. Number 2, we have Fibonacci. Number 3, this is a support zone. Don't forget, a supply zone is fresh. Yeah. Why is a supply zone is fresh? Why a resistance zone is zone that have multiple bands? We have 1 touch, 2 touch, 3 touch, then the 4th touch sold. How many confluence are there? 3 confluence. Now, the previous high. That spiked. Can you see how many confluence? Like 4 confluence. Now let me go to low and see what happened around that place. We have 4 confluence. Don't forget it. Let me go to 50. Oh, beautiful. Beautiful. What is this? This is London Eye that happened on the March. Now, traces it back with all the confluence we had. This is 6th of March. It happened 1st of March. This is 6th of March. You know, like I also said, it doesn't have to spike. It can close with a strong candle and close back with a red candle. What happened again? Can you see? With a valid entry pattern. Now let me go back to the other time frame. That's 5 confluence. Do you know what a confluence is? I'm sure you know what confluence is.
Yeah.
Look at. So even if witches and wizards are dragging the price upward, it will never buy, it will sell because we have many confluences confirming to us that it still will sell. Simple as that. Yeah. Simple as that. Same thing here. This is higher low. And this is higher. higher low, higher high. So, but around here, we only rotate this around the 50%, which is this. Can you see? But if we not drag it upward, the structure changed when it got here. So our higher was changed from this to this. Where did we get our retracement? Golden zone. Simple as that. Hope you are not lost.
No, I'm not.
Fibonacci is very powerful. So that's everything you need to know. About the Fibonacci, let me know if you have any question.
Not really.
Are you sure?
Yeah, I'm very sure.
Okay. Let me see the next class. And I hope you're practicing.
Yeah, I'm practicing.
So I think I hope no matter anything you're doing in the financial market, stocks, crypto, forex, indices, just know how to trade. You make money. So it's about focusing on your actions. So that's that. So all you just need to do is practice, and in the next class, like I said, go gold. For example, like I said in the last class, which was last week, I said
Yeah.
high and low as a liquidity. So I want to show you something. This is too much. Now, always remember, don't forget, a basic way of drawing a simple structure. Higher low,
Yeah.
higher low. Focus on the swings. Higher low. Higher low. From here, you add an higher until there. So we created a new low after taking out all liquidity here. All these things are liquidity. So created a new lower low. Here high, here low, here high, here low. Hope you're getting it. This is the higher high. This is the higher high. Here high, here low. Because it took out this liquidity. So it won't always look very simple like the textbook. So that's why practice will make you be able to identify them easily moving forward. Then where is the next higher high? Higher high. Then we have a major higher low that cleared out all the internal structure and liquidity. Then we have an higher high that changed structure. Now this is a change of structure. So now back to the original So what I want to do here before moving forward is I want to show you the similarities between previous high and low and session high and low. Now, this is higher high, higher low, higher high, and higher low. You get?
Yes.
But in this higher high, okay, higher low, higher low, higher high. Remember, this is an higher low. Why is it an higher low? We had inducement sweep and all these things, and we have a very valid order block here. So this is the last high. So this is the last low. Let me delete this. This is the last low. This is the last low before this high. Can you see? Now, market took out the previous low.
Yeah.
It's normal for you to cherry pick trades. You don't want to be entering trades anyhow. So if we, like I always said, if we can't spot something clear, just leave the chart. Because market is not always clean. So this is previous low. When market took out the previous low, simple as that. There sometimes it wicks it, like it happens like a weak rejection. So when they took it out, all you just do is go to the lower time frame and look for your entry pattern. I think next week we are discussing entry pattern. That one will change everything for you. So like you see, this is previous high. Same thing happened here. Out of all this it's called reaccumulation. We're still going there too. It's called reaccumulation. This is the last low of the reaccumulation. So we can also regard it as previous low. You get what happened after market took it out. All you just have to do is look for your lower time frame
Yeah.
and that's right. Yeah, you don't do okay. All right. What you have to do is look for your lower time frame entry pattern after taking out the previous low and buy. Let's look for something else. Same thing happened here. This is a previous low, like I've marked earlier. When price took it out. Price took it out and there are two lows. Previous low and the extreme low. This is a valid order block as small as it is.
Yeah.
How do you know? You know this is a valid order. So there's an extreme low here. So when price took it out, if I zoom in, you see that there's a little wick. So these things, everything the market is telling you is something. When price took it out, look at, like I always say, you don't have to wait for price to tap on the extreme zone, demand or supply zone. So when market took it out, it wicked it, and you go to a lower time frame entry pattern. Look for buys. Same thing happened here. This is previous high. What we were doing before is previous low. This is previous high. Market took out previous high and it sold. Market took out previous low. I hope you know this is a low too.
Yeah.
Previous low. Next. Pushed up. Market took out previous low. No matter how small it is, closed above with a bullish candle. It went up. Now that's previous high and low. I will now switch to 15 minutes time frame. Don't forget what I showed you here. I hope you can see my screen.
Yeah, I can see.
Like I said yesterday, I said the previous low I just did now is just a reference to what we did last week. So you can know the similarities. So now yesterday I said the Asian range trap. Okay, sessions in Forex markets. We have London session, we have New York session, we have Asian session. So on the Asian range trap, we have Asian range indicator. We have 15 minutes time frame for you to focus on, and we have liquidity sweep for you to focus on. Now, if you're also looking for session high and low, based on my settings, the 15 minutes time frame is all you need to focus on. Now we are on 15 minutes time frame.
Yeah.
15 minutes time frame. And the last place forming session high and low. Session high. The highest point market gets to in a session. And don't forget, this is London session. This is session low. The lowest point a price gets to in a particular session. So this is the London session low. This is the London session low. You can see that in the London session low and all these things, when we take it out, we didn't spike, and when market when it broke with a strong candle, it did not break back in. You understand? Yeah, we didn't spike, we broke with the body and we didn't break back upward into the low. Another thing here, this is London session low, the last low in the London session. And you also see this spike will only break with the body and you never broke back in. So you want to enter that kind of trade. This is session high. So now this is an opportunity for you to identify session high or low. This is a session high. The last point market gets to during London session. This is session low. The lowest point market gets to during London session. So this is actually simple stuff. This is session high. The highest point the price gets to during London session. And now you can see that all the sessions all the session high and low I'm showing you, we have not seen a valid we have not seen a valid trade because we haven't seen price spike upon getting to that zone, and we haven't seen price close back in. We are still going to find out though. This one is the Asian range I told you about. No matter how far it is, all you have to wait for is price to take out the Asian low and wait for your entry pattern. There's a buy opportunity here, but that's not what we are talking about today. This is London session low. For no valid trade. Now look at this one. Between this and this, which one is the London session high? Check carefully.
I think the second one.
That's very good. Because this first one, we are still in Asian range. So it falls between Asian session, the white background. So this second one is the London session high. Now let me draw the line and see. Simple stuff. You don't need to know everything in the market. Now look at, if I draw the line, what happened? Here, two things happened. We can call this a spike, and we can also call it a break back in. So if you go to your lower time frame entry, because we are on 15 minutes, if you go to 1 minute or 2 minutes, how many pips drop? This is a 608 point drop. It's on gold. You can just take your 1:2 here and leave. Trust me. Have your 1:2 and leave. You can see. So there are many things that happens in the market. There are many highs and lows you spot, but it's not all you will enter. The only ones you will enter is the one that proves that, okay, after it gets to that zone, markets broke back in to tell me that, okay, this thing will go up or down, or market spike. So let's go on. Where is the London high here? Session high.
It's the upper one.
What happened? And you see how this one went very far. This one, anytime you see market spike a zone and the spike close below the zone or it's close above, it is a buy trade. It's a very strong indication. You know that since I've been showing you, this is the first one that we've seen that is very, very clear. Can you see? It spiked. It's moved upward and spiked and closed below the zone. Look at very beautiful trade. Can you see how far it went? Can you see?
Yes, true.
Now, this is another magic. That's why some people like to use bigger screens. This is London session low, right?
Yeah.
This happened on the 17th of February, 2023, which is this year. Now let me extend the line and see what magic happened. On the 17th of February, we had the London session low. Then on the 23rd of February, that's like 18, 19, 20, 21, 22, 23, a week later, look at what happened. Lower time frame entry, this is a valid trade you want to be taking. Aim for your 1:2 or 1:3 and leave. Can you see?
Yes, bro.
It went like with just 3 candles. That was session high and low for me. Let me show you more examples. So now another thing, we have Asian high and low, and we also have Asian range. There are some times that the ranges will be Asian high and low. And there's sometimes like this one now. This is an Asian high and this is an Asian range. But this very day, the market didn't range. Do you understand? So our Asian high, our Asian high is here and our Asian low is here just before the London session opened. But in this case, on the 17th of February, the Asian high is the Asian range high and the Asian low is the Asian range low. Hope you understand. I hope you understand. If the market is ranging,
I've understood. I've understood. Like there are times where the go make a high before ranging in the Asian session, so that the high before ranging is the high. Then there are times where market ranges in Asia. Okay.
Exactly. So in this case, the Asian range and the Asian high and low happens during the range. But in this case, the Asian high and low happens outside of the range because that very day the market didn't range during the Asian low. So now what happened? When my price took out the Asian high during the third day of London session, what happened? It took it out and it's closed below. What happened? You can take your 1:2 and 1:3. You see, simple stuff. Now, same thing happened here. The Asian low was taken out. We had a break to the downside, but broke back in with a strong bullish candle. Did I take this trade? I can't remember. Okay, no, I didn't take it. I haven't traded gold since December. I've been trading just GBP/USD since December, since January. That's the only thing I've been trading. So now you broke back in with a strong candle. You look for your entry pattern. It happens all the time. You just want to be sitting on your hands and waiting for the right trade you can spot. There's an entry pattern here as well. I'll teach you where we get there. So it's either you scaling or you need to enter the value, like the most valid trade. This is another good example. The London low is spiked and closed above. You don't need to wait for anything else. You can just wait for the bullish candle to move upward. Put your stop loss below and target your 1:2. And if you want to enter at the fourth spike, you can enter at the second spike. Like I said, sometimes it doesn't spike, it closes with a candle. But the moment the next candle closes above the previous candle, which is what happened here. Can you see?
Yes, bro.
That's that about that. Same thing happened here. London session high is this. Then during the New York session, by on this thing, you know that that very trade happened around New York session. You're looking at now. I want to toggle on the New York session. Can you see?
Yes, bro.
So that move happened during New York session. So now I will toggle it off back because I don't like it to be it makes my chart ugly. So now the took out the London session high. What happened? It spiked, it broke below. Everything is showing you that this thing will sell. You just look for your lower time frame entry pattern. Simple as that. Trading is difficult because of the psychology behind it. But technicals need to be simple. There is nothing that you are looking for. Trust me. Even when you are losing, you will see the reason you are losing. You know that this trade I took, I'm not supposed to take it. I'm supposed to go this way. But there is no secret. Once you know what you are looking for in the market. Look at this. Like I said, this is the Asian high, and this is the Asian low. The market didn't range this day also.
Yeah.
So when market took out the Asian high, look at sold. You can enter here and take your own issue 2 and leave. This is 15 minutes time frame. That's why I enter on lower time frame so I can get a more, finesse entry and just take my own issue 2 and leave. Same thing happened here. The Asian high was taken out. So this very day, market spiked many Asian highs. It spiked the Asian high of the previous day. It spiked the London high of the 3rd day ago. Can you see?
Yeah.
So that's that about sessions high.
I think there was news. I think that day there was news. The spikes. I think that day there was news. I think there was news. I said.
Yeah. Very many.
Yeah.
Yeah, I think. Let me check the date happened. It happened Tuesday during New York and London overlap. That's why I love the fact that I'm trading London. More times, all those big news happen during New York session. So me, I'm already out of the market.
Yeah.
I don't like stress. By that time, I'm already out of the market. London session doesn't really have red news, but it has manipulations. It has manipulations, so it doesn't really have red news. The only time, maybe some random days, you see some very defective news that happens in the morning, maybe 1 hour after London session. Oh, good. So I'm just gonna hold into my London session. Let me show you more examples. Look at this one. This is London high. Two things happened there, guys, that showed me that we are going to sell. Number one, after we have a very strong candle to the upside, we have another strong candle that pushed down. One. Number two, never forget push phase and exhaustion phase. Push phase and exhaustion phase. Do you remember?
Yeah, I remember.
So now if you go to the chart, this is the examples. The example here is for bearish, but this is a push phase. This is a push phase. So market will surely exhaust, even though it wants to buy. It's either it exhausts back into this other block and continue upward. There's another block here. Can you see? So it's either it exhausts and come back there, push upward, or it's pushed below. And already we are on a downtrend. Structure-wise, we are on a downtrend. These ones are corrective moves. We are on a downtrend. This is not loading because market comes up here and can you see we're on a downtrend? That's number one. Number two, market took out the London high. So already I know that I will sell this market. Third confluence, a push phase and an exhaustion phase that had the candle close below. Then look for my entry pattern on lower time frame. Simple as that. Okay, now another one, liquidity, trendline liquidity that confirms to me that market will come down. Can you see? You see everything is entering each other. 1 touch, 2 touch, 3 touch. So that's it. If the USD will crash or it will strong, you don't know if the Japanese yen will become strong or weak. So people don't know. So there are 5 to 6 safe haven currencies. So investors tend to like take their money away from other currencies that they are not sure about, and they put it in safe haven currencies. The number one safe haven currency and safe haven instrument is gold. Whenever there's uncertainty in the world, people buy gold just to save their money so they don't lose. So whenever everything is balancing, they now buy gold back. This was when Corona first broke out. Investors was buying gold. This was when people started dying in the US. Look at how gold ran up on 4 hour time frame. Just imagine I bought this gold and I just close my chart and I leave it. So now when I'm coming Russia Ukraine issue last year, what time did it happen? Russia Ukraine happened.
I think that thing started last year. I don't know.
Yeah. Look at on 24th of February, Russia invaded some part of Ukraine. That's 24th of February 2022. Now let's go on chart and see what gold did that time.
Yeah.
I don't want to show you the reason for the negative correlation. So February 2022. Now look at this was when Ukraine invaded Russia, February 2022. Can you see the date?
Yeah.
Look at what happened to gold. So gold rallied from that February up to March for a whole 1 month. Do you see? Because there was uncertainty in the market, so investors will buy what's it called? We buy gold. Now let me see what happened that same February on GBP USD. You see that it might be different. Gold was buying, so normally GBP was supposed to be buying too, right?
Yeah.
So now GBP was selling. Gold was supposed to be selling, but it didn't sell. Look at what was happening. So anytime there is something strange in the market that investors are afraid of, there will always be a negative correlation between gold and the major pairs because investors will tend to buy gold. And when you buy gold and gold is paired against the US dollar, when you buy gold, it will move up. So see what happened that February on GU and see what happened that February on gold. Can you see? Same thing happened this time around. When the Silicon Valley Bank crashed, I think it happened this early March, gold rallied up. Whereas GU was selling. Can you see?
Yes, bro.
This is a down from here. Where is this one? I know. Can you see? So
Yeah.
now, like I said, what are safe haven currencies? Just make sure that all these videos we are recording, we are going back there. I think we have four safe haven currencies. We have gold, we have Japanese, we have the dollar, and we have Swiss franc. But let me confirm.
Yeah.
Oh, yes, I'm correct. As other safe haven assets, safe haven currencies are sought by investors to mitigate financial risk when economic turbulence hits. So these things are simple terms. So, but it's good for you to know about it, so you won't be surprised. You see, they said safe haven assets, same as safe haven currencies, are what investors use to mitigate financial risk when economic turbulence hits. When there is economic uncertainty, bad things. So the three major safe haven currencies are the USD, the Japanese yen, and the Swiss franc. Are you getting me?
Yes, sir.
So these are the three major safe haven currencies. But safe haven instruments, we have gold, number one. Sometimes when people don't buy gold, they buy Japanese yen or dollar. So now, I'm looking for gold. Everything in the video we are recording, you can just be going back to jot it down. So anything you understand or anywhere you get lost, you can ask questions.
Okay.
See what they said? They said gold commonly is commonly considered to be a safe haven in times of financial or political uncertainty, since it is not at risk of becoming worthless. Gold has been in existence for a long time. Gold has been trading gold for years. So no matter anything that happens in the world, gold will always be a very tangible asset. So they said gold is commonly considered a safe haven in times of financial, political uncertainty, since it is not a risk of becoming worthless. Unlike fiat currencies, which is dollar and the rest. Unlike fiat currencies, what they mean is, now, let's assume something bad happened in Japan. You understand? Even Japan has even Japanese yen as a safe haven currency. Let's assume something bad happened in Japan. Investors will take their money out of the Japanese yen. They won't buy Japanese yen. They want to put it in somewhere more safer. You understand? So in my opinion, I consider gold the best. So it works as a safe haven in a couple of ways. Let's start with the function of safe haven, blah, 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 blah. I can send you the link. All these ones are still, but you can just, go on. You send it the link. For the negative correlation that happened this week. So now, back to my question. Have you answered the fundamental analysis question?
Yeah, so the fundamentals drive the market, or the technicals give us entries. It's more like that.
Okay. And you're using phone to join this video, right?
Pardon?
You're using phone to join this video.
I did what?
Are you using your mobile phone to join this Zoom session?
Yeah, I'm using my phone.
I would have loved to. Well, okay, this is what I would do. I will give you an assignment today.
Okay.
I want you to submit it for me tomorrow. So you've answered this,
Yeah.
right?
Yeah.
So I want to give you assignment on market structure only. So I want you to go on gold. Are you with your pen and paper?
Yeah. I have a pen here. Okay. Let's go on golden.
So I want you to go on gold and Euro USD. I want you to mark from last week Monday. Okay, today's Friday. From Monday till today, I want you to mark structure on the 1 hour. I want you to mark a correct structure on the 1 hour time frame from Monday till today. I want you to do that on gold and Euro USD. So you submit
Okay.
it. You submit it for me tomorrow. Let me
Okay.
know. Let me know you get the assignment.
Okay. Okay.
You understand? What's the assignment?
To mark up the market structure on the 1 hour for both gold and Euro USD from Monday to today. That will
Yeah, on 1 hour time frame.
be Friday. Yeah.
So that will cover the market structure. Now demand and supply. What do you understand by demand and supply?
So for demand, for demand and supply, for that, this is where we buy from and we sell from. These are our entries, like the premium and discounts.
Come again.
I said, like the demand and supply, this is where the market drives and makes the higher highs and then lower lows during the market structure.
But you sure can identify them.
Yeah.
Okay. How many? Oh, look at this beautiful trade. I don't know, I posted something on the group. There were 2 trades today. I only trade GBP USD. This is a very beautiful trade. This is a supply zone. The market has been in the push phase. Now it's exhausting. It's exhausting. So it got to a key level. Like I said, key level is not for decoration. Always remember. It's either market reacts to the key level or it breaks it. So when market get to the key level, look at this very simple trade. We have a trend line liquidity. The market is likely taking down. 1 touch, 2 touch, 3 touch. It's like a conference. But your own is just to look for 1 issue, 2 issue, 3. So when market gets to the key level, what happened? It took out the Asian range. Can you see?
Let's go.
You remember, we discussed Asian range and we also discussed session high and low. So now, in this case, it took out the Asian range. Now, let me go to the 1 minute. So, a very clear entry pattern. I can enter this trade with my last savings. We have 2 clear entry patterns. Don't worry, I'll teach you the entry pattern. That's what we'll be doing next. very clear entry pattern. I have two there. So, but if I am to enter this trade, I would have entered the first one because I don't know if the second one will present. You get.
Okay.
So maybe let's say a 10 pip stop loss because EU is always has a lesser pips. I hope you know that.
Yeah.
Take when we should trade or when we should take and out. Listen, when we should choose most times in and out. I don't like stressing. I'll just set and forget and look the chart. Same thing on GU. And the 15 minutes price took out London I. We have equal I plus London I. So like two complements. Look at this place. This is equal I. Can you see?
Yes, sir.
It now happened around London I again. Never forget, the green box is my London session.
Yeah.
So if I go to the 1 hour time frame, simple stuff. If I go to the 1 hour time frame, there is a valid order block here. Am I correct?
Yeah.
A candle with momentum that broke structure to the downside. Created an inducement. So normally I know price is coming back to this upside. So now 15 minutes time frame, price took out Asian range. One. It took out London I that happened here. Can you see?
Yes, sir.
Now, on my 1 minute time frame, what do we have? Simple stuff. We have a very beautiful trade. Entry pattern. Enter upon candle close. Use my 10 to 15 pip stop loss. Target 30 pips. And just go out of the movement. So, can you see?
Yes, sir.
I don't trade on Fridays like I told you. So I don't go against my plan. If we go to 15 minutes time frame, there's also another trade opportunity here. You know, this is a valid candle. Can you see the other block there?
Yeah.
Yeah. So, and
Yes,
created inducement. The price came back to the other block. So let's go to the 1 minute. Oh my, this is beautiful. A valid entry. Candle close and enter around here. Or I might end this trade with a good even. But I didn't go far. Didn't go far. But if we are to look at it in another angle, we created change bias. The break of structure. Can you see? With
yes, sir.
liquidity, took out all the liquidity and tapped on the demand zone. When you enter, the candle close. No? Yeah? Yeah, I'm inside. No. Okay. I'm on live session. Okay. Okay. Sorry about that. So you enter and then you should chill and you're out. So that was just a quick, I showed you that there are two trades that happen today that are very valid. One in the morning on GU and one in the morning on EU. If I have to take the trade, I'll just close the chart and wait till Monday. So now I said you can identify demand and supply, right?
Yeah.
And you can easily identify imbalance.
Yeah.
Now, what are other blocks?
So other blocks are mainly also found on the demand and supply. So these are the last candles. When we are buying, it's the last down candle. When the last down candle, and then when we are selling, it's the last up candle before the breakup structure, before that big momentum move.
Very good. Very good.
Yeah.
And you can surely identify them.
Yeah.
Now add it to the assignment. When you mark structure, I also want you to identify other blocks too. Don't make your charts to look too rough when you're marking structure and identifying them, so I can be able to see what you are trying to show me. So you show me imbalance. You show me imbalance, market structure, demand and supply, and other block.
Yeah.
Write it down in the assignment.
Yeah, written it down.
Okay. Now, support and resistance. What is support and what is the resistance?
Also, support and resistance is like the opposite of demand and supply, but support is where the market has failed to go down. Then resistance is where it's like the ceiling.
Very good. So now, what did I tell you about?
Yeah.
Now the difference. Tell me the difference between the two.
But the difference is with the support fail price fails to go to price touches there many times, and also for the resistance also price touches there many times. It's not a fresh zone. In general, it's not a fresh zone.
I want you to put it in a better way. The difference between demand and supply and support and resistance. I want you to put it in a better way.
Like the difference?
Yeah.
Like with the difference with the support, yeah. With the support, this is where price makes a lot of touches. Like it's not a fresh zone. While for the demand, here there is always a fresh zone. For example, a fresh order block is being formed there.
Very good. Very good. Simple as that. So now, also in the assignment.
Yes, bro.
I want you to write it down. I want you to also identify liquidity and inducement. All these things I'm showing you is on these two pairs. So I want you to mark liquidity and inducement.
Okay.
I want you to mark session high and session low.
Okay.
That's all. So let me read out this thing again, the assignment.
The assignment is on gold and euro USD, and
Okay.
I'm going to mark up the market structure on the 1 hour time frame.
Okay.
That will be for this week from Monday up to today. I'll
Okay.
also identify the order blocks and imbalance, the
Okay.
demand and supply, and also support and resistance, and
Okay.
also liquidity and inducement, and the session highs and session lows.
What about other blocks?
Yeah.
So that's the assignment. So we will be reviewing the assignments tomorrow. So now I'm going to delete, let's move forward. I'm going to delete this accumulation and distribution.
It's okay.
You don't need it. Do you know why?
Yeah.
I want to teach you something that you will see results. I don't want to confuse you. You understand?
Okay.
I want to, like,
Okay.
before you are in March, before 2-3 months time, I want you to be seeing results, because you are not a complete newbie. So that's actually what you paid for, and that's why I am mentoring you. You don't need it. I might just add it to my courses when I do it, but to be honest, I'm being plain. You don't need it.
Okay.
Now I'm just gonna ask you: should I send the link, maybe just to study later, or I shouldn't?
Like what I know with accumulation and distribution, I think we talked about something which was similar, and that was
Yeah.
the
See,
push
let me just
and
let me
the
just go.
exhaustion.
Let me do go exactly. Let me go to it. Oh, see, I'll just delete it, but let me go to it. Distribution happens when market is ranging like this. You understand? It's trying to push up, but to first distribute. Then all of a sudden we have a push phase.
Yeah.
You understand? So
Yes, but
we can have something like this again. That's what we call redistribution, like it's distributing again. So when it's distributing again, it will push. Are you getting me?
yes, bro.
You know that now we market structure wise, we have it's crazy. Market structure wise, do you know why I said it's crazy?
Yeah.
Normal,
I don't know.
do teach people. I do teach people for free. Many people, I ask them questions. So you are the first person I'm going deep with. So it's funny because there are many things you will know, but you don't know you know until you start teaching people. All these things, I've learned them a long time. So I don't even know. Like everything I'm teaching you off handle. Do you know? I don't do pre-session practice that okay, let me practice what I'll teach this boy. Everything I list, I'm teaching you is offhand.
Okay.
So that's why I'm laughing. So distribution, you don't need it to be honest, but it's just good for you to have an idea. It's just like white curve. I don't use white curve, but I have an idea. So this is distribution. So I'll send you the picture. Then we have push phase. Then we have redistribution. Then we have another push phase. I'll send the new link immediately. I think I get more energy during this time because normally we are doing the class in the morning. I always get tired.
Yeah.
So this is push phase. Now, if the market is now ready to come down, do you know that structure wise already we have higher high, higher low, higher high, higher low, higher high. Can you see?
Yeah.
So now if the market is ready to come down, then we have what we call accumulation. This is accumulation. It's trying to come down. Then exhaustion phase, reaccumulation, and exhaustion phase. That's just that's what's that's the distribution and accumulation. Simple as that. So it's just like an added conference for structure. You will know when market is distributing. You know that market is going up. You will know when market is accumulating. That market is going down. Simple as that. You get
Yeah, I understand.
picture now. Then we move on to entry in the next 40 minutes. This one will end soon. So that's why. Can you see my chart?
Yes, bro.
That's why I just sent this one. It's just like I low type of things. So now I'm gonna be deleting it. I can just leave it here. So now entry module, very important. I'm gonna be teaching you two types of entry modules. Simple as always. This is a secret. Is it not funny? It's simple, but it's very powerful. We really need to focus on modules. I've heard about chalk.
Yes.
Now, the chalk that you will be entering with has to have inducement. Without inducement, never enter. I repeat, you want to be entering. There are two entry patterns. Entry pattern one. If you can't spot this entry pattern, never enter a trade, no matter how valid it is. I repeat, don't ever execute if you can't spot these two entry patterns. For the buy, a chalk that has an inducement. So, like I said, the first low when you're buying is the first low when you're buying is inducement.
Yes,
Then
bro.
something like this, or it has to have an inducement. So this is a flip and this is a chalk. My neighbors, yeah, you can hear the sound, right?
Yeah, I can hear.
I don't know all these kids.
From my side?
Oh, from mine.
Uh,
Change of character. For the sale. You understand now? So it's a chalk. We have a broken structure initially to the upside, then a change of character, then inducement. Now, this will bring me back to my playbook. So I'll be sending you my personal playbook. My playbook is everything I do on the chart. So I'll be sending you, and we might even be using my playbook as an example. Hey, what's up? Slow. Why is it slow?
There?
No, my network is slow. Let me just continue with my example. Now, for buying, this is the only thing you need to check. If you can't spot this thing, don't enter a trade. A change of character that has an inducement. So you will enter the market upon price taking out the inducement. So simple as that. After price take out this inducement, can you see? You have to make sure, remember, when you're watching this video, always remember, you have to make sure we have a bullish candle close above the inducement, something like this. Without a bullish candle, don't enter. Most times, like I said, it can close with a wick. What's wrong with these boys? Can you see? Once you can, after price took out the inducement, once you spot a candle that wick and close above the inducement, you won't enter yet. You wait for the next candle to also be a bullish candle. So if the next candle is a bullish candle, then you enter. That's the secret of the entry. Then you place your stop loss below the low and target your 1:2. Same thing here. You know that sometimes we have a flip, we have a sell, like a short supply zone, but it will fail. It will act as if it will want to play out, but it will, have a little reaction, then push up to the upside. Get? So after that, you have to wait for, see, never buy without price taking out an inducement, and never sell without price taking out an inducement. Because if you buy without price taking an inducement, you become the liquidity. You understand?
Yes, brother.
Same thing here. Let's delete this circle. Changing the position. Should have shown my playbook, but the network is slow. So we would have saved time, but I don't know what's wrong with it. But I'll still show you. Everything I do on a daily basis is inside the playbook. I don't do anything outside of it. If I do anything outside of it, maybe I go against my plan. Intentionally, I'll punish myself. I might not trade the next day. Now, same thing here. Can you see? A chalk that has an inducement and a
Yes,
flip
bro.
an inducement never enter a trade. Once everything is as aligned, you have your demand, your value demand supply, your liquidity taken out, your extreme liquidity taken out, you're trying to buy or you're trying to sell in line with the structure. Always remember, I know. So the last thing you need to wait for is an entry pattern. So this entry pattern, see, it constitutes several things. A chalk, but that chalk has to have an inducement. Then that inducement, after price take out the inducement, it needs to close above it. Remember, I said in a case where we don't have wick, maybe sometimes the wick doesn't close above. If you have a bullish candle, or sorry, a bearish candle that closes below, something like this. I want to make you still remember. Like I said, there are sometimes that we want to wick like this, you understand? But there are sometimes we will have a red candle, then a bullish that will follow. This is bullish engulfing candle. Do you know candlesticks?
Yes, brother.
Huh?
Yes.
What's this? What candlestick is this?
The bullish engulfing candle.
Okay.
The one which covers the whole body of the red candle or the whole body of the blue candle when it is going up, it's the bullish engulfing. So it engulfs all the red candle. Then the one that goes down is the bearish engulfing that engulfs all the candle.
Exactly. So you want to wait for two scenarios. But most times, the one that works very well is this one. When price closes above this inducement with a wick, you want to wait for the next candle. After you have to wait for the candle to close. Then you want to make sure the next candle that comes is a bullish candle. Then you watch market execution. But in a case where you don't have a wick, you can have something like this. You see? Can you see?
Yes, bro.
So in a case where you don't have a wick, you can also have something like that. But most times the wick works faster and more better. So now same thing on sell. I hope you understand this example.
Yeah.
We'll go through it again. On the sell, to make sure you have a candle that closes below the inducement. Then you want to make sure the next candle is a bearish candle. Don't do the mistake before you enter. But you sell. Same thing on this thing for the sell. You want to make sure that's why you see most times it looks like my stop loss is small. It's because I've entered the market after I have a directional confirmation. So this is the entry pattern you need. Please, nothing else. But this thing, as simple as it is very powerful. Now let me check if my playbook has come up. I don't know what's wrong with this thing. Well, while we are waiting, let me show you examples on charts. So everything will begin to make sense to you now. Like I showed you earlier, this is in the morning. Can you see?
Yes, bro.
Now this is a change of character. Market got to a key level. Another thing, I always say that when your market structure, a break of structure has to close with a body. So I don't know if you would jot this thing down, but when you are entering a trade, a break of structure doesn't have to close with a body. I want you to take note of that. When you are entering a trade, because this trade, we are on 1 minute. See this break of structure. We can't consider it a week because we are trying to look for sales and price has gotten to a key level. So let's assume we have seconds. I don't have seconds time frame. If we go lower to seconds time frame, this week is no more a week. Seconds time frame will show that is a body. So if you want to enter a trade, I don't know if you write it down, a break of structure, that's the only time when you want to enter. That's the only time you don't have to wait for a body break when entering a trade. A week can be considered as a break of structure. So we have a break of structure to the downside. So this is break of structure. Break of structure. We also have a break of structure to the downside, but in this case, it's now a change of character. Where is the inducement? Where is the inducement?
It's here in between where exactly where there is that what in between that choke, the word choke.
Yeah.
No? Down?
Yeah. No, we are trying to say. This is the inducement. Because this is a break of structure. Chalk is also a break of structure. The reason it's called a chalk is because it's changed character. It's showing us a confirmation that market is changing, because if you check now, the market has been going up, 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 up. So the reason it's called a change of character is because it's confirming to us that market is likely going to reverse, change its character from upward to downward. So, and I told you that when you're entering a trade, a week can also be considered as a break of structure. So now, don't forget, an inducement is when you're selling, inducement is the first high after a break of structure. And when you're buying, an inducement is the first low after a break of structure. Now, this is inducement in this case. Do you get it now?
Yes, understood.
So now, I said in a case where you don't have a week, don't forget, in a case where you don't have a week, normally I said the week works best. But here we don't have a week. All you have to do is wait for candle to close below the last, this candle. Then you will enter with the market execution. You put your stop loss above previous high. Oh, Nigeria. Do you guys have 24 hours supply? Do you guys have 24 hours electricity in your country?
Without okay, the for us we have a major power supply, like as a country, yeah, like we generate electricity, but the problem is, yeah, we have a dam, like we have a dam that supplies electricity to East Africa, like I say, the whole of East Africa, like Rwanda, Tanzania, where. But the problem is the government, like the electricity rates are higher than the people we supply to.
Okay.
Yeah.
So, like I said, after price took out inducement, in a case where we don't have a week, you wait for price to close below the candle that broke the inducement, and you put your stop loss below the last high, maybe 10 pips, and you target your 1:2. Can you see? This is for the sell. Now for the buy, let me check. Now, very good. For the buy example, let me check gold. I want to use a very clear example. Gold has been rallying up. This is crazy. Now, this is do you know this is London low?
Yeah.
And like I said, when price takes out every highs and lows, price will most likely return to the opposite direction. So this is London low, and we had a sweep around here. So now March 2, I want to go to lower time frame and show you the Now what I said about chalk is a chalk. break of structure to the downside, then a change of character. Now, where is the inducement here? This is in the inducement. In this case, it's a week, like we can regard this as a week. Can you see?
Yes, bro.
So when price took out the inducement, what happens? All you have to do is wait for the next candle to be a bullish candle. Put your stop loss below the last low and target your work ratio 2, 1 ratio 3. Simple as that. Can you see? I hope you are not lost. But it's a bit technical.
Yeah, it's a little bit technical. Like,
So you get it. I don't know why my playbook is not showing. I'll just send you the picture. Don't know what's wrong. I'll send you my playbook. Don't worry.
okay.
For the sake of better assimilation, we will still go over this tomorrow. Now, same thing happened here. We had a break of structure to the downside and a change of character. Now, where is the inducement? The first low after a break of structure. This is confusing, but it's okay if you don't get it. I want to show me where is the inducement?
The inducement, it's up, like down. Yeah, no. Yeah, that's one.
This one. This. Final answer.
First.
I can't hear you.
The next one.
Is it this or this?
But I think it's this one, the last one. This one.
This?
Here. Yeah.
No. You are correct, it's this. Because we had a small break of structure here. Like I said, when you are entering, a week is also a break of structure.
Okay.
And this is the first low after the break of structure. Can you see? So now in a case like this, we still have a lot of room to the downside. So you can just mark the next possible candle with an imbalance. Let me zoom in so you see. There is nothing left for price to come and meet this down. But if you zoom in here, there's an imbalance here. Can you see?
Yes.
So in a case like this, when price tap on the candle and you see a very bullish candle like this, all you have to do is just enter with a market execution after the candle close. Put your stop loss below this low to be on the safer side. You see that price came back down. So assuming we are all these smart money trader that are just tightening their stop loss, we'll be taken out. But we are correct. So target your 1 ratio 2, 1 ratio 3, and you're good to go. Can you see?
Yes, bro.
Let me show you more example. I'm actually seeing examples, but I want to show you a clear example. Because all these ones are confusing. I'm only seeing them because of experience. So I don't want to, I'm seeing examples, but I don't want to show you the ones that are not clear. On Monday, there's an entry here. I'll zoom in. That's a very tight one. That's fine time. Let me see to add an entry here. Same thing happened here. Look at, we have a break of session to the downside. Then we have a change of character. Where is the first low? The inducement. Where is the inducement?
Let me see.
This is the inducement. That's a low.
Okay.
So when price took it out, all you have to do is wait for. In a case like this, we really have a week, but we have a candle close. Then you put your stop loss below the last low, target your run ratio 2. Simple as that. It's okay if you don't get it completely. We'll go through. Tomorrow will be about. Tomorrow will still be on entry pattern. We'll go through various examples. Various.
Okay.
So let me show you more example. Let me move to GBP USD. I took a trade on. Okay, look at this is Friday. We had a push to the downside. Where is the inducement here? Where is the inducement? This is the inducement. Well, can you see?
Yes, bro.
Then price reach it and close below. All you have to do is wait for the next candle to be a bearish candle. You enter with the market execution, put your stop loss above the previous high and wait for your ratio 2. Simple as that. I took a trade on. I didn't trade on Thursday. So I think there was an entry pattern around here, but I couldn't enter because that was not a valid entry point for me. So now we have a break of structure, a change of character. Where is the inducement here? This is the inducement. Can you see?
Yes, bro.
That's the first high after the break of structure. So if I zoom in, you see that the price reached it. So this is a cool and perfect example of. See, when price reached it and closed below, all you have to do is make sure the next candle that is coming after that one is a bearish candle, which of course it is. Then you enter here, put your stop loss above the last high and target your run ratio 2. Simple as that. Can you see? Can you see the entry pattern now?
Yes, bro. Yeah.
When the break of structure to the downside, we had a change of character here. Where is the inducement?
It's there. Down. No. Yeah. Yeah.
So when price took out the inducement, always remember, if the price does take an inducement, don't enter. you still make a lot of mistakes. That's why we start to demo. So you will learn actually when you are already practicing. So you don't ever buy or sell without price taken on this one. When price took out, we have two inducements here, previous low and equal low. Can you see? So when price took it out,
Yes.
we didn't have a week here. We all have to wait for price to close above the last candle. You enter out the market execution, put your stop loss above the last low, target your raw ratio 2. That's it. We are done. Can you see? Simple stops. I entered the trade here on Thursday. Someone asked me why. I entered this trade. I sent it to the group. Can you see?
Okay.
Enter this trade. I saw the market as the entry pattern. That's why I entered. Let me show you. I saw that there was nothing left to mitigate. Price has already mitigated everything that is left here. Can you see? Price mitigated it. And the structure is bearish. Then all I waited for is simple. Simple thing. All I waited for is, and I saw that there's nothing left here also. So all these things are price rejection because there's no imbalance, there's nothing. Look at a change of character. Where is the inducement? Yeah. Where is the inducement?
Pardon? The inducement, yeah.
Where? I'm trying to sell. This is the inducement. The last
There. Yeah.
Then after we had a week, I entered around here, I think. My stop loss was like 18 pips. I think I entered around here. My stop was like 18 pips. I remember it was approaching my stop loss, but later went in my direction. And I closed at 1:2. This trade, can you see the entry pattern?
Yes.
Same thing I did here. Nothing difficult. That's it. So the live session, I'll be sending this video. So tomorrow, 8:39, we'll still be discussing about entry pattern. We'll start over again. But don't forget the assignment. So if you can't submit assignments tomorrow because of the it's the time difference, you can submit it on Sunday.
Okay.
But don't let it pass Sunday.
Yeah.
So do have a wonderful night and I'll see you tomorrow.